is it likely that I'll get it back? Let's say that you go, yeah, they're not going to, it's too much work in the property, whatever. So you take that into account. And if I get it back, what's my exit plan? Mortgages are highly tradable or assignable. So if you've bought a mortgage and you have it and or you've loaned money and you have this mortgage, you can take that, and there's all kinds of outlets all over the place that are looking for privately held deeds of trust and mortgages that they can purchase or trade. So that might be one avenue. Second avenue, make it easy for someone to afford it. If you have all this equity within the property and within the note, $100,000 property that you've only loaned $50,000, you can turn that over and allow another real estate investor to come in with $20,000 and pay you off and leave some room on the bone there for somebody else to take over the issue or problem. And just dealing that portion of it. If you want to get a tenant, great. If you want to, here's what I need from you as a down payment. If it's another investor. One of the craziest things that's happened in 2008, we had a whole portfolio. All kinds of different people that were buying property. What happened? Why did that happen? Do you know why that happened in the 2008 market?
So it was
overall economics of it boiled down.
Bad loans, right?
Mm-hmm.
So there was the mortgage companies were advertising the adjustable rate mortgages. People were getting in at a 2% interest rate, and then a few years later it would jump up to 8, 10, 15%, and they can no longer afford their payments. So the banks who initially held the loans then sold those bad loans off to Sallie Mae, Freddie Mac, the big loan portfolio holders, and people started defaulting.
Well, and that's true, but it wasn't as much about making a bad loan, because if you make a bad loan to somebody against an asset value, let's just call it a $100,000 loan again. You loan $98,000 against a $100,000 home. The fact that you loaned 98% of it makes it more likely that you're going to get that property back, because the borrower then, anything that happens in the marketplace, if the values go down and dip a little bit, they might look at it and go, I owe more than it's worth. I'm walking away.
Right.
So that's one thing. But the second part of it was the snowball of appreciation because they made loans easy to get. Okay? So they artificially raised the value of all these properties because they made it easier. They made less down payment, less verification of income. Mm-hmm. All of these different things were a factor that made everybody be able to buy one, and supply and demand drove the prices up. So it was a combination of they drove the price up and then they required less down payment. So a house that was worth $100,000 became worth $200,000, and then they loaned 98% of the artificial $200,000. And then when reality set back in and said, all these other buyers aren't real buyers, they don't have anything into it, now it came crashing down. And that's why we were seeing property out there that would normally sell for whatever get artificially taken up, in the fact that other properties, they had to discount them so much to get out of them, mm-hmm. that banks and things like that were just selling them off, short sales. Everything was going on in that amount of time. All of a sudden there was a glut of foreclosures. I was looking at property that you go, I can buy this property for less than what it costs for the lumber package. Now, that's the time to have the capital, right?
Right.
I don't care what it is. If a 2x4 costs what a 2x4 costs, and all of them together, you're buying a house for less than it costs for those minus labor, that's the time to bulk up. However, there was no industry to loan on it. So it took a while, and the pendulum has, went from that side all of a sudden to the other side of, all right, now we want you to be Bill Gates in order to qualify for this, and we're going to verify everything. Mm-hmm. And then it made, the monetary policies just made it be such that, okay, we screwed that up, but now we're really going to be rock solid. And what we're seeing is that at least the pendulum's coming back, and they're starting to make more loans that make sense. Still down payment that's used. Yeah, you have to verify your job and all of those different things. But because of that, all of a sudden, private lenders are more valuable.
Right.
And so in looking at the market, you can go, okay, where am I going to be more valuable? Where are the economic situations such that it will allow me to place my money in something where someone has good income and a good down payment, and that the market's stable? We've talked about North Dakota, for instance, because of the oil boom in there. Texas is another one that's happening in that area. What we have to worry about is, are the numbers artificially high because it's all of a sudden, that's the area, more people in the supply and demand? That's something to look at. But you can be wrong a lot when you're loaning $50,000 against a $100,000 property. Even if you're 20% off on what the real value is, you haven't affected your position.
Sure.
You know what I mean? So interrupt me with these if you have questions too, because this is just, like I said, I want to discuss them and bring some real life. I love real estate notes. Most investors start to do flipping until they build up a nest egg, and then they go, man, I just want to put some money out there and let it earn. I know what I'm looking for. Let somebody else go out there and do the rehab, do it,